What does that look like for you? What does financial freedom mean to you? Perhaps it's the ability to retire early, or maybe it's the security of a hefty emergency fund. Or perhaps it's the freedom to pursue your passions without worrying about the paycheck. Regardless of what it may be, defining this vision is the first essential step on your journey to mastering money. It's about understanding your goals, your aspirations, and most importantly, your why. It's about having a clear, compelling vision that will guide your financial decisions going forward. It's about developing a deep sense of self-awareness, understanding not just where you want to go, but why you want to get there. This introspection forms the foundation of your financial journey. Remember, your vision of financial freedom is your North Star, illuminating your path in the world of finance. A solid financial foundation begins with the mastery of two critical elements, budgeting and debt management. Imagine budgeting as your financial compass, directing your money where it needs to go. It's about understanding your income and expenses and making intentional decisions about where each dollar should go. Categorize your spending into needs and wants. Needs could include rent, groceries, utilities, whereas wants might include dining out, entertainment, luxury purchases. The goal here isn't to strip joy from your life, but to ensure you're prioritizing your financial health and long-term goals. By identifying areas where you might be overspending, you can make strategic cutbacks without feeling deprived. Now let's tackle the elephant in the room: debt. It's easy to view debt as a dark cloud looming over your financial landscape, but remember, it's not insurmountable. High-interest debts like credit card balances can spiral out of control if left unchecked, so it's essential to prioritize these. Consider strategies like debt consolidation, which involves combining multiple debts into one with a lower interest rate, making it easier and potentially cheaper to repay. You might also explore the snowball or avalanche methods. The snowball method involves paying off the smallest debts first to gain momentum, while the avalanche method focuses on paying off the highest interest debts first. Both methods can be effective, but the best choice depends on your personal circumstances and psychological makeup. In essence, managing debt is about freeing up your future income. Every dollar used to service debt is a dollar not being saved or invested for your future. And while debt can sometimes be a necessary evil, like taking out a mortgage to buy a house, the ultimate goal should always be to minimize and manage it effectively. Remember, a well-managed budget and controlled debt are the bedrock of your financial house. With these in place, you'll be well on your way to building a sturdy financial future, one where your money works for you, not against you. With a solid foundation in place, it's time to build your wealth through saving and investing. We've all heard the saying, "A penny saved is a penny earned." But what if we told you a penny saved could be a penny doubled, tripled, or even quadrupled over time? That's the power of consistent saving and smart investing. Let's start with saving. The key to successful saving is consistency. It may seem like a daunting task, especially if you're just starting out, but remember, the journey of 1,000 miles begins with a single step. Start by automating transfers from your checking account to your savings account. This way, saving becomes a non-negotiable part of your money management, not an afterthought. As your income grows, increase your savings rate. Even a slight bump can make a significant difference over time, thanks to the magic of compound interest. Think of it as earning interest on your interest. It's like a snowball rolling down a hill, gathering more snow with each turn. Now, let's turn our attention to investing. Investing is essentially putting your money to work for you. It's about buying assets that you believe will increase in value over time, be it stocks, bonds, mutual funds, or real estate. But remember, all investments come with a degree of risk. That's why it's crucial to diversify your portfolio. Think of diversification as not putting all your eggs in one basket. By spreading your investments across different asset classes and sectors, you reduce the risk of any single investment dragging down your entire portfolio. Investing can feel intimidating, especially if you're a beginner. But don't let that deter you. Start with low-cost index funds or diversified mutual funds, which give you exposure to a broad range of stocks or bonds. As you gain confidence and knowledge, you can consider branching out to individual stocks or other investment options. Remember, every dollar saved or invested is a step closer to your financial freedom. Financial freedom isn't just about numbers, it's also about cultivating the right mindset and habits. Indeed, in the journey towards financial independence, one's mindset and habits play an essential role as significant as the numbers on your bank account. It's like a garden. You can have the best seeds, but without the right soil and care, they won't flourish. Let's start with mindset. Adopting a positive, growth-oriented mindset is crucial. This means viewing money as a tool, not a goal. It's about understanding that money is a means to an end, be it security, freedom, or the ability to make a difference. It's about viewing financial setbacks not as failures, but as learning opportunities, and understanding that financial independence is a journey, not a destination. Next, we delve into habits. Good financial habits are the daily actions that bring your financial goals to life. They provide the structure and discipline required to manage your money effectively. One such habit is consistency. Whether it's consistently saving a portion of your income, consistently investing, or consistently tracking your spending, consistency is key. Over time, these small, consistent actions can lead to significant financial growth. Another critical habit is continuous learning. The world of finance is complex and ever-changing. Staying informed about financial trends, investment options, and economic indicators can help you make smarter financial decisions. Lastly, let's talk about patience. Financial freedom is not achieved overnight. It takes time for investments to grow, for savings to accumulate, and for financial strategies to pay off. Patience is, therefore, a virtue in the financial world. In conclusion, achieving financial freedom involves more than just mastering numbers. It requires cultivating a positive mindset, developing effective habits, and staying committed to your financial goals. It's about the journey, not just the destination. Remember, your mindset and habits are just as important as your financial strategies. So, arm yourself with the right mindset, nurture the right habits, and you'll be well on your way to achieving financial freedom. While you build your wealth, don't forget to plan for the future. That includes retirement planning and tax management. Let's talk about the future first. Retirement might seem like a distant reality, but it'll sneak up on you before you know it. Proactive planning is vital to ensure you have a comfortable nest egg to lean on when your regular income ceases. Different retirement accounts can play a significant role here. Think of individual retirement accounts, or IRAs, and 401ks. These accounts offer tax advantages that can accelerate your savings growth. For instance, with a traditional IRA or 401k, your contributions are tax deductible, and your investments grow tax deferred until you withdraw them in retirement. On the other hand, a Roth IRA or Roth 401k allows for tax-free growth and tax-free withdrawals in retirement. Each of these options has its own perks and limitations, so it's crucial to understand them and choose what aligns best with your retirement goals. Now let's shift gears to tax management. Taxes are an inevitable part of life, but with strategic planning, you can optimize your financial outcomes. By understanding the tax code, you can take advantage of various deductions and credits that reduce your tax liability. For instance, if you run a small business, expenses like office supplies, travel, and even a portion of your home used as a home office can be tax deductible. If you're an investor, long-term capital gains can be taxed at lower rates than ordinary income. The key here is to keep abreast of tax laws or seek advice from a tax professional to ensure you're not leaving money on the table. But remember, retirement and tax planning aren't set-and-forget tasks. They require regular review and adjustments as your income, expenses, and life circumstances change. Remember, effective retirement and tax planning can significantly boost your financial freedom. Finally, remember that the economic landscape is ever-changing. But with the right strategies, you can thrive amidst economic volatility. It starts with maintaining a healthy emergency fund. This is your financial safety net, helping you weather unexpected expenses or income loss during economic downturns. Diversification is another key strategy. By spreading your investments across various asset classes, sectors, and geographic regions, you reduce the risk of substantial losses. Think of it as not putting all your eggs in one basket. During economic downturns, opportunities often arise for those who are prepared. For example, lower asset prices may offer chances to buy stocks or real estate at a discount. And remember, economic volatility can also lead to innovation and new market opportunities. So stay informed, stay flexible, and be ready to adjust your financial strategies as needed. Remember, financial freedom means being resilient and adaptable, ready to seize opportunities whenever they arise.